This morning's GDP report showed the U.S. economy growing by 1.6%. That's well weaker than the 2.5% that was expected. But with consumer spending remaining strong, what does that mean for inflationary pressures and potential rate cuts? Joining us now to discuss, former Reserve Board economist Claudia Sahm. Claudia, great to have you here on the program with us. Maybe I'm just flabbergasted trying to figure out what this print means for the Fed and how it changes the tenor of their conversation at the next meeting, if at all.
The Fed's going to look at data big picture, right? So one number, particularly thinking about, it was a surprise on what the markets thought, that is not enough to really move their thinking. And in particular, and you mentioned this, consumer spending looks really good under the hood. Business fixed investment, so set aside those inventories, the investment business making are really good considering interest rates are a lot higher. And so that's what we think of as kind of the underlying pace. Where do we think GDP is headed? Today we got hit by imports had a bigger drag. That's a very noisy series. Inventories were a little into play. These are not things that should change our view on the economy. It's been strong. It continues. The underlying pace continues to be strong. That's not bad for the Fed, right? We had a strong pace last year. Inflation came down. Frankly, the Fed thinks it can lean on a strong economy a little bit, get it some time to get comfortable with inflation.
Claudia, when you take a look at this number, when you take a look at the fact that maybe PC is going to surprise here to the upside if we do see any sort of elevated print here tomorrow before the bell from PCE, what does it signal just in terms of what the Fed is then likely to do? How far out could we potentially be pushing that first rate cut?
Everyone said, and absolutely the Fed, Jay Powell, when he's been out talking towards the end of last year, there had been some real progress last year, but it was going to be a bumpy ride. Well, we got our bumpy ride in the first quarter, and the progress really slowed. There has been progress. It's just been really slow. The target index for them, the personal consumption expenditure index, has looked a little better, but still it's slow. They want to build confidence. Confidence takes time. So we are pushing out, I think, where the Fed probably will start their cutting. And yet we are set up for them to cut this year, and probably more than once. But you know what? They're going to be driven by the data, and there's a lot of data we don't have yet.
Yeah, and Claudia, that's a good point. And I want to bring up the move that we're seeing, the action that we're seeing in the yield market today, because that bump higher in yields obviously tied to that pricing data that we're getting in this GDP print. But you say that it is likely that the Fed is still going to cut before the end of the year. What do you think then what does the Fed need to see in order to be confident to make that first cut? And when we talk about the improvement, I would guess that you're expecting then to see on the inflation front, where do you see inflation then trending between now and year end?
There is a very clear path. Given what we know now, there is a clear path for inflation to slow. And in all likelihood, we're going to see a pickup in that disinflation. Maybe not as much as last year, but we're going to get moving. The Fed's target price index is within a percentage point, less than a percentage point of the 2% target. And they have told us over and over again, and it is good practice, they will not wait until 2% to cut. So we got to see more progress to 2%. Things can't stall out. And goodness, they cannot inflation pick up. Again, the Fed's going to be driven by what it sees happening in the world. And yet we know things like the shelter prices, the owner's equivalent rent. We got more data on the rent people are, like the contracts they're signing now, have really come down. So it's in train. We see it, but we have gotten surprised. And there could be other surprises down the road. So I understand why markets are having a hard time getting a read on the data. And yet we should remember that the Fed doesn't wake up, look at one release and go, wow, we have to totally change our thinking.
Where do you think the data, especially on that housing front, needs to continue to trend towards in order for the Fed to feel confident with its cut decision when they do make that?
The Fed is looking for things back to normal, which doesn't mean it has to look exactly like before the pandemic, say in terms of inflation. But if you look at the pieces of the quote unquote excess inflation, so like what pieces of spending are running above the inflation before the pandemic, the leader is the shelter, particularly the owner's equivalent rent. We have every reason to believe we're pointed in the right direction of that slowing. Do we know how much or how fast? No. I mean, it's coming much slower than what we had expected. the other piece, I mean, there are some other pieces of services, and some of it's pretty eclectic and echoes of COVID. I mean, the consumer price index, motor vehicle insurance is another big excess. That isn't as much in the PCE, but it just shows we have far fewer enemies in the fight on inflation than we did in 2022, and yet they are still here, and some of them are going to be tough.
Claudia, Sahm, we really appreciate your insight, especially on a day like today. Thanks so much for hopping on early with us here on Yahoo Finance. Claudia Sahm, Sahm Consulting founder.
Thank you.